All right, so today we are going to look at this question called HS equation. As you recall, this is part of those questions that have to do with decision making, and there are all sorts of different decisions that you can find here. So let's first find out what this is asking for us to do. So they're asking us to calculate the optimum or profit maximizing selling price of a component for the period. Then identify and explain 3 reasons why it may be inappropriate for HS to use the theoretical pricing model in practice, the one that we have found up. So this is about pricing, and of course, before you read, before you got the scenario, perhaps you know about the different passages of pricing, so you would probably think about what they may be asking you to do. But when you go through the material, so they're saying that we manufacture components for use in computers. We operate in a highly competitive market, and there are a large number of manufacturers of similar components. So we are considering pricing strategy for the next 12 weeks for one of the components. So everything we are reading here, as we said, always has a reason why they have put it here. So highly competitive market, where there are a number of manufacturers for similar components. So that in alone will let you know that if you set a price that is very high, then you're not going to actually get customers, because people will eventually end up using your competitors. So, so that means that you should ideally market or price your product such that the the amount that you end up charging is reasonable. So usually there are people who would charge something that is less than what everybody else is charging, and whether or not that is a good idea is also subject to discussion. Then some people would charge the price that is very similar, and then there are others who charge more to attract premium customers. So there are different ways of looking at it. So, but here we are trying to look for a strategy that we are going to use for the next 12 weeks. And then they want to look at how we shall maximize the profit. Now, when you hear maximizing profit, basically, here we are looking at marginal revenue, marginal cost. Remember, in the previous session, we had questions that were hinging around that. And that is what I am saying. And this is going to end up being when you look at maximizing profit. So basically, this one just tries to put you at a point where you're maximizing your profit. And then the second part asks us whether we can set this price theoretically. That's when we shall now come and talk about, of course, what other people are charging. So here we have market data for demand. So right now we are selling it at 1,350, and the demand over the last 4 weeks is 8,000 components per week. Then the analysis shows that if we increase selling price by 50, demand reduced by 1,000 components per week. Then if we increase 50, demand increases by 1,000 components per week. Now, this is going to help you determine the price-demand relationship. Now, of course, with the price-demand relationship, the demand-price relationship should move the same way. So even if they don't put this part here of equally, we normally deal with it the same way. So we assume that price increases, the demand decreases by the same amount, same components as it would if price has increased or decreased the other way around. So that helps you create a relationship that we are going to create for the demand. And then, of course, when it comes to the costs, they are saying that Each component is 270 for the direct material. So it's part of a fixed price contract, and the contract does not expire for another year. So it means that we at least have this price. We have this price locked in for the direct materials. When it comes to production labor and conversion costs and other overheads and the corresponding output volumes, these are collected for the last 4 weeks and they are showing us here. So when they have output these units, this was the cost. When they output this one, this was the cost, and so on and so forth. Now, there are no significant changes in cost expected over the next 12 weeks. So, let's give me a second. So, this is what we have. So it means that we can now try to see how we can price. So we are going to look at the costs, then the demand relationship with our price. Then we can now see how we can actually get the one that gives us the maximum. So like we said, so if we go and we set up, okay, so now the HE equation. So as I said, we have two sets of information. The one is demand, the other one is cost. So we can get the price, the price demand equation. So it's usually written as price is equal to A minus BQ. So that's the price demand equation. Now, so what we have, so the current price is 1,350, and they're saying that over the last 4 weeks, this is what we have been saying, the demand. So we are going to use this information to calculate one of the parameters, but what they have told us here that when the price increases by 50, demand falls by 100. So now A, in this case, is usually the intercept, and B is the rate of change, okay, of price with demand. Because here the demand is the X, so we can get that rate of change of price with demand. So basically what we do, we just say to get B, B is going to be so now from here, if you try to rearrange this equation, basically B will equal to the price divided by the demand. So now the price here they gave us 50, demand 1,000. So B becomes 0.05. Now from here we can now get A if we use this component here, 1,350, 8,000. So 1,350 is equal to A minus 8,000 times Q. So if you try to arrange this, A will equal to, basically that's going to be 1,350 plus 8,000 multiplied by Q. So A will equal to what? Oh, sorry, that is not Q. This is B, because Q is the 8,000. 8,000 is the B. So in this case, we are getting, so it's equal to 1,350 plus 8,000 multiplied by B. So A becomes 1,750. So having got our equation, we can now come here and say, therefore our equation is P is equal to 1,750 minus 0.05 Q. So this is our price equation. So now to get actually our marginal revenue from this, marginal revenue is equal to A minus 2 BQ. Okay, like I told you last time, if you have this information, if you know it, then that is good. But if you don't know it, you can differentiate. But really, we don't need to go into how this comes about. But this is the formula for marginal revenue. So it means that you can say P is equal to 1,750 minus, so that becomes 0. I think 1 Q. If you multiply it by 2. So that is the marginal revenue. So now let's go to the cost part. So now the cost part, they already told us that direct material is 270. So at least we have that. But the production, labor, and conversion costs together with other overheads have this relationship. Now, to get the now, of course, in this case, one thing that can let you know whether this cost is completely variable is if you try to divide the money by the volume. Okay, so this is not something you're going to do in the exam, and I will show you what to do basically. But let's say you wanted to know whether they are variable completely, because these are costs that include they include production, labor, conversion costs, and other overhead costs. So ideally, it is not going to be expected that they are going to be variable completely, because variable costs, overheads have fixed and variable. But let's say you did week, output, and then cost. So week 1, 2, 3, 4, 9,400, 7,600, 8,500, 7,300. So if you wanted to see whether it was completely variable, if you divide 7,000 or rather 7 million by 9,400, you see you get 0.744. If you try to drag it out, you don't get exactly the same, but you see that there is some component of it that is variable. So It means that these are what we call semi-variable costs. Now, there are three types of costs. We have fixed costs, we have variable costs, we have semi-variable costs, we even have actually step fixed costs or something. They call them step costs, where they are fixed, but after some number of units, they now change to another fixed amount. So where you can think of something like you have yourself a warehouse, so the fixed cost for the warehouse, but then after you exit that warehouse, then you get another warehouse, so you cut down fixed cost for two warehouses. So that goes like that. Now, how to determine if you have a fixed cost and a variable cost? You have these step costs, then you need to do what we call the high-low method. The high-low method is one of those ways that can help us to determine the variable component, because we are looking for marginal costs. Marginal costs are variable costs. We already know this 270, but we need to get the component which is in this data here. So how that works is that you get the highest, okay? So you get the highest cost, and actually you look at the volume itself, the output volume. You look at the highest volume and look at the lowest volume. So let's try to actually sort this data. So this is the lowest volume, this is the highest volume. So we get the difference between the two volumes and also the corresponding costs. So what we do to get the variable component, we get the difference between the highest volumes, and we want it as a, so we start with the highest, the cost corresponding to the highest volume and the lowest volume, subtract them, divide by the difference between the highest volume and the lowest volume. So this gives us 0.74 as the variable component. Okay. And this is 0.74. But remember, these are thousands. So if I multiply this by 1,000, that becomes 740. So these are 740. That's the variable component. Therefore, you can get our marginal cost. It will be this 270 plus the 740. So that becomes our marginal cost. Now for maximization, marginal revenue is equal to marginal cost. Therefore, we are going to say 1750 minus 0.1 Q is equal to 1010. So you solve that equation. Of course, when you try to arrange this, you're going to find that Q is equal to, so 1750, then minus 1010 divided by 0.1. So Q is equal to 7,400. So after knowing the Q, then you can now bring this price back, so that you want to find what is the price in this case. So price will equal to 1750 minus 0.05 multiplied by our Q, which gives us 1380. So this is the profit maximizing price. Before we proceed, is this clear?
Yes, it is.
Okay, so you guys already knew about the high-low method?
Trying to remember.
Yes. All of these things are in those recordings, so but I know sometimes when you see them being done, you feel like maybe you didn't see them there, but they are there. And in case you find that you need to get a refresher, you can always look up that recording and get a refresher on it now that you have seen it being done here. But that is what the high-low method is. You can check the textbook for if you need to get yourself better appraised with it. So, but that's the first part. Now, the second part is the theory part, which is trying to basically identify reasons why it may not be appropriate to use this theoretical pricing model in practice. So, now, reasons why. Okay. So now these reasons kind of come from the fact that when you are looking at price maximization, we assume that the demand is clearly moving as price, because that's what we have done here. We have assumed whenever you use this equation, it means you're assuming that demand is linear. Okay, so the first one is the assumptions. So it assumes demand is linear with price. In other words, it assumes perfect elasticity. Okay, so it assumes perfect elasticity. Uh, so, but that's not usually what happens, because sometimes as you increase demand, or as you increase the price, demand might fall, but a point reaches where the price has increased so much and demand doesn't fall linearly. People just go away from your product altogether. So that is one problem. But so now, because of that, it means that you can actually uh, predict a wrong price. So because this is not a reason in itself, but this means the price predicted might be wrong if the assumptions don't hold. If this assumption doesn't hold. So which means that if that's the case, you may have predicted a price which is higher than actually it is that you should be setting. So when you set a very high price, that means that you lose some of the demand. So that is a problem. Then the other thing is the other assumption that it makes. It assumes that there is perfect competition. Okay, assumes perfect competition, and the way it assumes it is that if the price is okay, ideally you have market share. But that's not what normally happens. Sometimes you can have a good price set, but then because probably maybe there is a monopoly or an oligopoly where a few players gang up on you, and then they set prices that are going to affect you, then that can also cause problems. So it assumes perfect competition. And if this does not exist, the model may predict again wrong wrong profit maximizing selling price. So that also can cause problems. So what other reason may it fail? It also fails. Now you see how we did this computation here, where we have to get a variable cost. It can also fail if these costs here, they were step fixed costs, because then it's not easy to get a good variable cost, since the fixed cost also will change after some volumes. So it also fails to predict a good selling price when the nature of costs is that they are step fixed costs. So these are some of the reasons why the model may not be very good, but all in all, it is usually a good model. It predicts better than what you normally would expect from the other methods that we can use. So I don't know if you know the other methods. We have things like cost plus, and the cost plus methods have marginal cost plus, then there is full cost plus, then we also now have the one which uses target cost. Okay, so we have seen this other up, and then other costing methods. So you need to know what each of those costing methods assumes, so then you can be able to tell how to best use them and when each one is better than the other. So this is this question. It's not a very small question. Much of these answers are from the calculation part. It is a good question if you know what to do, but it's also easier for you to fail to figure out how to deal with it if you've not been practicing questions like this. So it's important that you practice several questions. And now I'm looking for one that, yes, so let us do this question. I don't know if I've done it already in the question that I uploaded, but it's good. Let's work it out together here. So it also deals with the decision to be made. But in this case, they are asking us to advise on whether either of the joint products, uh, okay, whether either of the joint products should be further processed and also get the optimum production plan for period 3. So we shall see how to deal with joint products. And then also based on this production plan, prepare a profit statement showing each product should profit for the period, and then explain why joint processing costs are considered irrelevant when making the further processing decisions, but are considered relevant when assessing the profitability of the overall process. And then, of course, discuss benefits for DAISY investing in an enterprise resource planning system, that is ERP. And this one sort of comes from way earlier in our studies when we look at business technology, which some of us are usually exempted. I know that the textbooks have this information, so like in case now like you found it, you can always read it from there. But this is knowledge that comes from those earlier classes that we have, I think the very first paper. So here we look at what is told about the scenarios that we are looking at. So they're saying that there is a large chemical company one of these chemical processes produces two joint products. When you produce joint products, it means that at first as you are going through the chain, you go, and then afterwards you get two products like this. And then from here, usually the decision is whether you should process both or one or none. Okay, we are going to see whether this one is one of those sort of questions. But we at some point we have netto and we have monkey. Each of them can be sold at the end of the joint process. So like we said, you can easily just sell them without processing them. We can further process them into enhanced versions of products called the netto plus and the monkey plus. So from here, you can go and make a netto plus and a monkey plus. Or you can just terminate from here and sell each of them. So here they have told us the joint products, the joint process, and then the further processing for period 3 is shown. So we have the joint process costs. So the total output, of course, is 500,000 liters. We need to first know how they are broken down for the netto and monkey. Maybe they will tell us. But the process costs before you reach that point, we have incurred material of 6.3 million and variable overhead of 2 million. By the time we reach this point for the joint process costs, then now the products are here. So of the 8 million, they are portioned them like this, and they are telling us something down here that they are cautioning them on basis of output. So that means that we can from here know how many liters were for netto, how many were for monkey. And then we have, actually they have told us the liters here, 300,000 and 200,000. So we know the selling price at the split off. If you don't process them further, you can sell them at 20 and 18 respectively. But if you process further, then you can sell at 25 and 29 respectively. But what costs are you going to incur per liter? 8 and 4 for processing. And then no more loss if you process further. For the netto, you don't lose anything. But for the monkey, you lose 10%. And then selling price of normal loss. So if the normal loss in this case is going to be some sort of waste, you can sell it at 1.5. So for the monkey. So then they tell you the notes that are here. And the first one, we saw it. Note to say is normal loss occurs at the end of further processing. So the daisy production manager for this process needs to decide on the optimal production plan for period 3. She's unsure if either of the joint products should be further processed. So this is the decision that we need to make. Okay, and one thing I want you to notice when you are looking at these decisions is they are usually, okay, there are some that, of course, they fall under categories. So when you have done many questions or when you are looked at the notes, you can try to see those categories. But at some point, they need you to think and reason them out as and when you get the question. So you need to have the knowledge, but then you also need to have the intuition. So here, if you look at it, it's just a matter of looking at whether it is beneficial to process further or sell right away. And that means which one gives us the best revenue. So for period 4, they are deciding that 280,000 liters of netto and 220 liters of monkey plus will be produced. And then the apportioned joint costs for period 4 are given 4.5 for netto and 3.3 for monkey plus. Selling price for the processing costs and normal loss are the same as the one that are in period 3. And they are saying information on cost and selling prices collected by different departments within the ACCA and is coded on individual departmental spreadsheets and systems. It is often not shared with other departments, so the production manager rarely has access to up-to-date information. She has heard of the ERP and wonders if one could be of use. Uh, Really, this is something that, as I told you, comes from somewhere in those first papers, but if we are working, which I believe we are, we use a sort of ERP system at work. Whether you know about it or not is a different thing, but it's what you normally use to manage your work, your start work, like leave, like when how you look at your pay slips, when you're paid, those kinds of things. Finance people use it to when you're requesting for money to probably go and do an activity. Some of those things that I don't know. I've not yet. I don't know where you are working, so I don't know if you do have the system. But we shall look at the benefits of having such a system. So let's first look at our first question to just look at whether or not to process further. So okay, so now for us to see whether we shall process further or not, as I said, we should look at the benefits. And the benefits are going to be in terms of cost. So let us compare. So we are going to compare it for the netto and for the monkey. So we are going to compare. So now, so let's compare the costs and the revenues. Because of course, if you sell at split off points, so revenue at split off, I'm going to work here in dollars, not thousands, so I'm just going to use dollars. So that means if I'm at split off is $20 times 100,000 liters. So that is 6 million. Then for the monkey is 18 times 100,000. So that's 3.6. Then revenue from further processing. No, revenue after the further processing. So when you do further processing for the netto, you sell at 8 and there's the same 300,000. But for the monkey, you say that have I used the right amount? No. 8 is the further processing cost. I'm supposed to use 25. 25 multiplied by 100,000. And here, 29 is 200,000. So it means that when I process further, this This is extra revenue from further processing. But something you might have noticed, we have not yet considered the fact that here, when you process further, you have some loss. So they say that there is a normal loss of 10%, which means that here we are going to actually get 90%. So the real revenue is 1.62 for Monkey, but also there is also revenue from the normal loss, because they said that once we lose that, we can sell it at 1.5. So it means that we are going to get 1.5 multiplied by the 200,000 multiplied by the normal loss, which is 10%. So shall we sell that normal loss for 30,000? So we can now first get the sum of these two as the total extra revenue. So you can have this total extra revenue. Just for us to track it, I can now put it there in yellow. Or we can call it incremental revenue. Okay, total incremental revenue. Okay, so now we can look at the costs. Now, incremental costs. So the incremental costs, these are the further processing costs. So H times 300,000, that's 2.4. And then for this one is 4. $800,000. So that we can now get the incremental profit or loss. So you can see that when you compare for the netto, you make a loss of 900,000, whereas for the Monkey, you make a profit of 850, which means that for this one, we should not process, but for this one, we should process. Therefore, we can say we should process the Monkey further. However, we should sell the netto at the split of point. Is that clear? Is it understood how we have come to that discussion?
Yes, it is.
Okay. So then they also said that based on the optimal pricing production for period 4. Oh no, the optimal production plan for period 3. Of course, here we just say the optimal production plan is 300,000 liters of netto, and because we are losing 10% for Monkey Plus, because we are losing 10% for monkey. So we are going to set 200,000 times 0.9. So that gives us 180,000. Monkey plus. Okay, so that means you are saying for netto, all of it that you make, sell it, don't process it further. But for the monkey plus, for the monkeys, process it and sell monkey plus. So that's the optimal production plan. So that is part A. Then part A, Roman 1. So Roman 2. So this is for Roman 1. So for Roman 2, they are saying based on the production plan for period 4, we make a profit statement showing the product profit for period 4. So they told us for period 4, they are going to sell 280 liters of Nestle and 220 liters of Market Plus. So we can start from there. So they want to produce 280,000 liters of Nestle and 220 liters of Market Plus. So they will be produced. So this is what will be produced. But if we look at if we say actually if we want to produce 220,000 liters of Market Plus, it means that basically we shall actually produce a little bit more than this in terms of monkey, because remember there's that 10% loss. So actually, if we are considering this, we are supposed to increase it. We increase it by 10%. And I'm trying so this is the 80%. I mean, this is 90%. So if you multiply this one by 100% over 90%, actually that should be 224, 244, 444. That is for monkey, not monkey plus. So we would have to produce 280,000 for netto, 444, 444 for monkey. Then what we end up selling, so that is 280,000. And then for monkey plus, we sell the 220,000. Okay. So now, having known what we are going to produce and what we are going to sell, then we can now get into the money. So we are still going to work in dollars. So what's going to be my revenue? So the plan is using the same selling price. So it means that we are going to get the selling price of netto 20 multiplied by here they are the same amount. So we are going to use this to 80. Then on this one, we are going to use after processing. So 29 multiplied by 220,000. So that would give us the one for market plus. But there is another amount of 1.5 multiplied by the 10%. And the 10%, in this case, you can easily just do like this. Okay, that should give you the 10%, the loss. So that gives us 6.4. Then we have the apportioned joint cost. So they gave us apportioned joint cost 4.5 and 3.3. Then further processing costs. Remember, we're not processing the netto, but we are processing the monkey. And it costs us $4. So that is the further processing cost. Now, we don't have any other costs here, so we can now get the total. So that gives us our profit. That's the profit that we get from the what? The transaction that we have made. Okay, I don't know if it's clear, I understood. If you have any question on that. Hello,
No question.
no question. Okay. So now, one thing you should notice, what we are going to actually answer in the other part is that when we did the first part here, we didn't talk about joint costs. They had said these are the apportioned joint costs, but we didn't look at them. Whereas here, to get the profit, we have actually brought joint costs in. And that this question is asking us that explain why we didn't look at these joint costs when we are looking at further processing, but we consider them when we are trying to assess the profitability of the overall process. Now, so the reason is simple. If we are looking at further processing, all the costs that are being incurred until the split off point are irrelevant. All that matters is that after that split off point, what more incremental costs or revenues are we looking at to make the decision? So in that case, the joint costs become sunk costs because we have already incurred them either way. So it's a matter of you figuring out how to write it. For the decision, of further processing, the joint processing costs are irrelevant because they are already spent and you have no bearing on whether to further process or sell at the split of point, since they will be spent either way. So that is how I'm wording it here. But for the profitability of the entire process, they become relevant because it is not a decision anymore, but rather a calculation of the total costs and revenues from the entire process. Okay, so I mean, if you want to get a better wording, you can always look at the solution to see whether what they did correctly or wrongly, but at least that's the gist of the information, in that when you are looking at the decision to further process, whatever has happened up to until that point is no longer a point, because we are incurring those costs. We already incurred them, and therefore we just now need to see, should we incur more costs to process or not. So the last question looks at the benefits for investing in an enterprise resource planning system. So ERP. So before we discuss this, as I said, most of us who work have these systems. So do you guys know about this ERP system? No one has that system at their work.
We do have one at us.
You do have one,
Yeah.
but you wouldn't know the benefits it has.
No, I know some benefits.
Okay. So you can probably tell us some of them.
Okay, so okay, one of the benefits, I think it helps link different systems, like within, like which is it? Which is communication and flow of communication within the organization. Yeah. Like just as you had said, for example, requests, maybe facilitations from sales and all that are easily worked out through that system. Like you can link it to a sales accounting department and all the other functions in the organization.
Yeah, that's a good advantage. Any other that you can think of? Okay, so thank you for the response. So An ERP system is an integrated system that has all major functions in an organization. So here you think about things like finance, procurement, then you can think of operations. Okay, different companies have different departments, but at least we have some that are similar, like HR. Basically, you have them integrated, okay, in one system. So the easiest benefit, of course, is that it links them, and it links, actually, here we don't say systems, but we are going to say links different departments or functions, because the system is only one. It links different, the system is one which links the different functions and which is the flow of information. So for example, a person in finance can easily run a report to get all the people that are employed in the company on the HR side, and able to verify now that they have been paid their salaries and all those deductions have taken place the right way. So you don't have to rely on a report that HR would send you. You can be able to extract it yourself. So also it eliminates redundancies. For example, having different versions of the same information stored by different departments. So imagine finance has your file because they want to pay you. So they know, but they know your name, they know your age, they know your bank account, they know which department you're working in, they know how much you're paid per month. Then HR also has your name, your bank account, how much you're paid per month, because they need to keep information about you, all of that. Then probably even your department has your file, which has your name, and those things are slightly different from different departments, and they are just redundant. You could find that sometimes information may actually start being distorted in one of them. That's how you hear about things like ghost employees in companies where in HR there is a file that, or in finance there is a file that is being paid, but that file does not exist in HR or the other way around. So that's the problem, and basically having ERP will remove this problem. So it can also allow a holistic view of company performance. Okay, by use of dashboards. So there are dashboards that can be set up since the system is pulling data from everywhere. Then you can set up dashboards that can tell you things like company turnover that comes from HR, looking at the staff costs, and then also revenue per employee. Some of those things that you can be able to pull out and get information that can be used for decision making at the managerial level, even at strategic level. So that is something that also ERP can actually provide you with. But of course, also, if you look at the question, you need to see whether when they say discuss, you should probably also throw in one that also represents that the ERP system is costly and thus benefits should be weighed against the costs of implementation. Okay, so you need to have that also in mind, such that you can be able to benefit from the ARP system, but without pulling so costs. So what here we are trying to mean is that some companies, like if you are a size which is not very big, revenues are not so big, like you may not benefit really from incurring these many costs for setting up an ERP system. You'd rather still use your archaic methods of everybody having information, and you still like you look at the costs that you be involved, and then if you are able to stomach them, and if you are not, then there's no need for you to do something that is not going to really benefit you. So this is some of those benefits. And as I said, if you find that you need to read more about the ERP system, you can do so in the textbook. Eh, the one for business technology, but also I think in the PM, the textbook should also have that material provided to you. So that's it for today. But